In this lesson, we're going to go through some practical trading examples, and we're going to use these examples to really dig deep into the reasons why I've seen so many people over the years who are actually in command of an extremely profitable trading strategy. They know and they understand it. They have sound technical analysis skills, but yet they're still not consistently profitable. And I've narrowed it down to these 3 fatal mistakes that these traders make that just completely destroys their edge that they have. There's also a really cool spreadsheet. Well, I'm kind of hesitant to use the word cool to describe a spreadsheet, but I like spreadsheets and I think it's pretty cool. So yeah, there you go. So there will be a link in the notes below the video for you to download your own copy of the spreadsheet, which is a probability calculator that is a really powerful tool that's going to help you to think in terms of probabilities and see the outcome of different strategies depending on both their strike rate and reward to risk ratios, which we'll go through during the lesson together. So the final piece of the puzzle to truly understanding probability and profitability in trading is random distribution. Now, random distribution is the random order in which winning and losing trades are likely to occur. So essentially the sequences of our wins and our losses. And I believe that a lack of understanding in this very concept is a significant part of why so many amateur traders, they lose confidence and ultimately lose money in the market. So in trading, we talk about random distribution in reference to when winning and losing trades are likely to occur. So the random distribution of winners and losers, because no one on earth knows the sequence of what their winning and losing trades will be. Now, one of the most unproductive habits that an amateur trader can adopt is trying to predict when they think their winning trade should occur. And this obviously is just going to lead to frustration caused by that expectation discrepancy. And then that frustration can lead to imbalanced perceptions, really emotional, reactive, and that impulsive, primitive behavior. Time and time again, I see traders, they have a decent strategy, but they still can't seem to make money. And I do think it's the failure to truly understand and grasp the key concept of random distribution that often leads new traders to make the following 3 fatal mistakes that completely destroys their edge in the market. So the first of those is changing position size risk on each trade. So this is where traders pick and choose different levels of risk on individual trades. So they might risk 1% on one trade, then on the next trade, they start to have a really good feeling about it. They feel overcertain because they think they know what's going to happen next. So they decide to risk 3% on it instead of just strictly sticking to 1% risk per trade continuously. So then the second fatal mistake they make is skipping high probability trade setups. So, the classic cycle of fear and greed, it can cause traders to potentially skip taking a trade if the pain from recent losing trades has caused them to maybe hesitate or develop a fear of execution. And then the third and final mistake is hopping between strategies. So an amateur trader may experience some drawdown, during potentially some choppy and corrective market conditions, but then maybe they go on Instagram and they see social traders, appearing to bank some really nice profit, who potentially even trade a completely different strategy. And then what does that do? That gives them some FOMO, and then they switch over to another strategy. But by the time they do so, generally the market conditions have then flipped back to an environment that actually suited their initial strategy, and then they end up missing out on what would have been a series of highly profitable trades. Now, all 3 of these mistakes are unfortunately so common amongst the uneducated losing traders, and it just completely screws up the probability model of a profitable strategy actually working in their favor, when they commit to these mistakes. So whenever a trader has reached out to me for help, when they have a good strategy, they know what they're doing with the technical analysis, right? They've got good skills, but they're confused as to why they're not consistently making money. I will ask them, how long have they been trading that strategy? How many trades have they taken? And how many valid trading setups have you missed in that time period? And a really common theme that became very clear very quickly after asking them these questions was that they had taken a very low amount of trades, usually less than 10, and they had not tracked any missed trading setups in that time period either. See, almost everyone has a discipline to stick to the rules, 5 or 6 times, but eventually, if results aren't showing, we naturally begin to ask questions. It is against our very nature to keep doing something that doesn't work, right? Because with a 60% strike rate strategy, by the 10th trade, most beginners was reasonably expected to have won 6 times. The numbers seem to add up. 60% of 10 trades should mean 6 winners, right? So why haven't I won 6? Well, in a perfect world, one where results are perfectly and evenly distributed, this theory would hold true. But in the real world, however, this is simply not the case. Results of any experiment or trial involving chance are not perfectly and evenly distributed. They are distributed randomly such that the underlying edge, right, so the expected result of the strategy, will play out over time. The time in which it takes for that underlying edge to play out is random, and that cannot be predicted either with any degree of usable accuracy. So this is the only area of successful trading where luck actually plays a role. So sometimes your edge will play out, in the first few trades, sometimes in the first 20 trades. In situations where the edge is so slight, like in a casino, it might take 200 spins of the wheel for an edge to play out too. Now, some traders, they might end up having a relatively smooth ride on their account equity curve that gradually moves from the bottom left to the top right, with their total profit pretty much remaining in the green from the very start of their account activity. And they need to keep a little faith at the start during the first run of trades as it just dips slightly into negative territory and then floats around the break-even mark for a short while before eventually the edge starts to play out and the profit curve really starts to take off and then the big money is earned. Other traders, however, they may experience a much more choppy account equity curve that can track sideways and even be in the red for quite a while at the start. They can experience a lot of losing trades before their profitable edge really starts to play out. Now you can clearly see the differences between the two account equity curves when we just looked at when they are placed side by side. Now the surprising thing here is that both of these equity curves were produced from a probability calculator that had the exact same strike rate and the same reward to risk ratios for both accounts. The profit curves are generated from the exact same profit expectations in an extremely controlled environment. This just goes to show the true nature of how results of any trial involving chance are distributed randomly. So let's take a quick look at that probability calculator. Okay, so this is the probability calculator that I've built. And just like all of the downloads, you can make a copy and save this down to your own drive so that you can keep it for life, play around with it, and you can be able to edit it. So if for whatever reason, when you clicked the link below this video, that it didn't ask you to save your own copy, then if you just click File on the top left hand corner and click Make a Copy, then you can save it down to your own drive. So yeah, essentially how this spreadsheet works, it's very, very similar to the one from the coin toss spreadsheet from the What is an Edge lesson earlier in the module. And essentially you have 5,000 trades this time, and it randomly assigns numbers to those trades. So the three columns that you have to play to work with, the three rows I should say, is the strike rate, the average win, and the average loss. So let's start out with the a standard coin toss experiment. Let's say you have a 50% edge, and when you win £100, and then when you lose £100. So yeah, just remember again, like the coin toss experiment spreadsheet, to make sure that you put in a positive number here and don't put in a negative number if you're lost, just because the spreadsheet will not work. So yeah, as you can see, strike rate is 50%. So what it does, it essentially then distributes your wins and losses across all of these numbers down here, just in a random way, but based on that edge there. Now over here, it gives you a little bit more information. So it tells you what the actual true strike rate is of those 5,000 numbers. And it's very rarely the exact number that you put here. It's usually within plus or minus 1%, but a very slight difference, even just 0.1%. across 5,000 trades can make quite a sizable difference to your equity curve. So that's just why you've got a little bit more sort of accurate information here, because if you look at this kind of, equity curve that you have here, right, and then if we were to do it again, so I'll just refresh it by putting in a different number and I'll put in 50 again, you can see, look at this, right, this is a 50-50 edge, looks completely different. Like, and this is kind of a perfect example actually of just what's popped up here of, this is where the strike rate is actually quite a bit higher than 51, but it kind of just shows you, there or thereabouts, 1% difference, just how different your equity curve can look like, even though that's pretty much the edge of a coin flip. You win, it's a 1-to-1 risk to reward, right? You win as much as you will lose on your losers. And look at this, right? You go nowhere, you break even for what looks to be about, 2,000-3,000 trades, and then boom, you're off. You've nearly made, 13-14 grand there. Like, it just kind of shows you, the real kind of, maybe just change this again, back to 50%, and let's see what, and then you get another one, right? So imagine you literally have a 1-to-1 risk reward. You have no edge, right? Over time, it's shooting it out and break even. Yeah, look at this. At some point you're nearly over 10 grand, and then it comes all the way back down again. And now if there's, if we expanded this to another 10,000 trials, it's going to come back down eventually to £0. So that just shows you kind of how, just the true random distribution of winners and losers, and how luck actually plays a massive role in the sequence of your winners and losers, right? The other thing you need to see as well, even with a 50% edge, you can have 12 consecutive wins in a row in a sequence, and 10 consecutive losers. So at some point in here, when you're flipping that coin, you're going to hit 10 tails in a row. Now imagine if that's you when you're trading, right? And you've got a 50% strike rate, right? Ignore the risk to reward ratio for now, but let's say you had even really a high reward to risk ratio. Like let's put in not even that high. Let's just put it really simple, right? 3-1, definitely more than achievable, especially with a 50% strike rate. And look at this, you can have 10 consecutive losses in a row. So although you make an absolute fortune, right, with this edge, and you're smashing over 500,000 over 5,000 trades, and remember this is without compounding, right? So it would be a shit ton more if there was compounding in here, but this is basically assuming that you withdraw after every single trade, right? You hit 10 losers in a row. Now if you're on the charts, right, and you hit 10 losers in a row, I'm sure you're going to start doubting and questioning your ability. You're going to start doubting and questioning your strategy. You're probably going to start struggling, to take that next trade. You're going to start feeling that fear of execution, that fear of loss, and you're probably going to start making mistakes, and you're probably going to start, not 100% following your trade plan with zero, with emotional interference really kind of getting in the way. So this is just a really, really kind of useful spreadsheet and useful exercise to go through. And look at this, like imagine in that period, right? How many trades is that? 21 trades, and you've literally just won 3 trades. So this could be played out over a number of weeks, or it depends on how active you are in the markets. You're going to feel like you don't even know what you're doing, the strategy is awful, you can't make any money, yet you have an extremely profitable edge here. I think a lot of people can kind of understand this in theory, and they go, yep, I get it. But when you're in the middle of that actually happening in the markets, with your real money on the line, it's a very, very different story, between the people who can actually deal with that and accept it and really understand it, and the people that don't. Because the people who do get it, they really accept it, they're the ones that end up, sticking to their trade plan, remaining cool, managing their emotions, and they manage to trade through it. Now, again, that doesn't mean that when you're in losing streaks that you just keep blindly executing trades, just going, it's just a probability model, and it's just digging yourself into a massive drawdown, because, you need to make sure that you really are reviewing your trades and making sure that those losses that you took actually were valid and part of your trade plan. They're part of your strategy edge, and they were high probability trades. And if they were, then that's okay. Then and you can believe in and trust your edge. And, it's very likely that you're just basically, at the hands of random distribution at that point. But then likewise, the complete flip side to that, if you, hitting 10, 12 winners in a row, but kind of what your edge looks like, what your median looks like, if it's around 50%, then that you're essentially trading above the average, and you need to ground yourself and prepare yourself for that inevitable kind of losing streak is probably going to start soon, right? You're probably going to hit 5 or 6 losers in a row, or a few, or at least 5 or 6 losers out of the next 9 trades, for instance, just to bring back that down to your expected, your expectancy essentially. So this is a really, really useful spreadsheet. This will become even more useful kind of later on, as we get later on in the program, when you have obviously devised your own trade plan and you've done a lot of testing on it, you've collected a lot of data, and obviously the ongoing data that you actually collect in your trade journal from the trades that you're executing, and you'll have a lot better idea of what these 3 numbers look like. Then you can punch that into here, and then you can just have this at the forefront of your mind all the time, right? Have a scroll through here and just look, at sometimes it's going to feel like you really don't know what you're doing, even though you do, and you have an amazing, strategy and edge in your hands. And this can just really help you to kind of get a bit of perspective. Sometimes, no matter how experienced you are, I think it's always worth, saving this to your desktop, quickly popping it open, and just having a quick look. So have a play around with it, see how low you can even go with strike rate and your, risk to reward, and see, how low you can go and still get away with being, breaking even or just being slightly in profit, because you can see the slight differences between a 4-1 or a 5-1 can be the difference of whether or not you're profitable. It's very, very fine margins. Even if we just drop that down to 4.1, there you go, just about break even, but then, in decent profit. But if you were to put that down by just £10, right, you can end up sort of more break even. It's really, really useful tool, depending on if you want to kind of go for those high strike rates or those kind of slightly lower strike rate, but then higher RR. Really cool spreadsheet. I think this is really powerful and definitely will become very useful as well, like I was saying, when you've collected more data with your testing, but also your live trading data in your journal. So save a copy, play around with it, and make sure you revisit this plenty of times throughout your trading career. So, as the majority of amateur traders do not understand and completely underestimate the true nature of random distribution, the first two of the three fatal mistakes that are very commonly made are changing position size risk on each individual trade and skipping high probability trade setups. To show the damage that this can have on your account returns, let's run through some examples with three different traders. So the first trader is Sam, and he trades consistently. He always sticks to his rules. He always follows his trade plan by always risking 1% on every single trade, and he always executes high probability trade setups that he identifies. The second trader is Sarah. She also executes all of the high probability trade setups that she sees, but she breaks her rules by varying her risk on each individual trade. And the last trader is Tom. He keeps his risk fixed at 1%, but he has a bit of a habit of hesitating and skipping some trade setups. Now, all three of these traders all trade the exact same strategy. They all have identical trade plans, all with the same rules. Now, the first trade setup for the strategy occurs, and it is actually a winning trade. Sam perfectly follows his rules, and he executes the trade with 1% risk, and he ends up banking a 4% return. Sarah also sticks to her rules. She risks 1%, and she also banks 4% return. Tom is feeling confident at the start of the new month, so he perfectly follows his rules, executes the trade, and is also rewarded 4% for his efforts. Now, the second trade setup ends up being a losing trade, so Sam takes a small minus 1% loss. Sarah was feeling very confident after winning her first trade, so she decides to break her rules, and she risks 3% on this trade, so she ends up with a painful minus 3% loss just on that one trade. Now, Tom is still feeling somewhat confident on the back of his previous win, so he executes the trade and he takes a 1% loss. Now, the third trade setup also ends up being a losing trade. Sam obviously takes another small minus 1% hit. After taking a big loss in the previous trade, Sarah's starting to feel really angry at the market and she wants to make her money back. So she doubles her risk, again, risking 6% on the trade, resulting in a large minus 6% loss. Tom's, however, he's feeling a little bit unsure after taking a loss on the previous trade, but he's still in a small profit for the month, so he decides to still execute the trade, and then also takes a minus 1% loss. Now, the fourth trade is a pretty sizable winning trade, and Sam continues to stick to his rules and is rewarded with a 10% winner. As Sarah is now sitting in drawdown, as her last two trades were both losers with high risk, she is feeling very skeptical and resentful, so she only risks 0.5% on this trade out of fear, so she only banks 5% instead of 10%. Tom has now also lost the last two trades, and as he doesn't understand the probability model of his strategy, it takes a massive hit to his confidence, and so he decides to skip this trade setup as he just can't face the pain from another potential loss, and he ends up missing out on the large return. So the final trade of the month happens to be a winner, and once again, Sam consistently sticks to his rules, follows his strategy perfectly, and banks a 2% trade. Sarah's fed up with trying to second guess the market by varying her risk, so she finally decides to just stick to her rules, risks 1% in the trade, so she also banks 2%. Now, after seeing the previous trade that he decided to not get involved in, and it ended up being a huge winner, Tom decides not to be fearful this time, and thankfully he executes the trade, and he too banks 2%. So, to end the month, Sam, who was the most disciplined and consistent trader, he ended up on a total return of 14%. Sarah, who decided to vary her risk on each trade, depending on how her emotions were and how she was feeling, because she thinks that she can predict what's going to happen next, she only finished the month on 2%, despite taking the exact same trades as Sam. Tom was disciplined with his risk management and kept his risk small and consistent at 1%, but he let the fear of losing get the better of him, causing him to hesitate and skip a high probability trade setup, which ended up being a big winning trade, and he finished the month on just 4%. So, although all three traders close out the month in the green in this example, destroying your edge by varying your position size risk and skipping high probability trade setups is going to have a massive negative repercussion in the long run. Because that 10 to 12% difference between Sam and the other two traders each month, that will add up to a ridiculously large amount of profit when it's compounded month on month, year on year. Yet they all have the exact same strategy and the same analytical skill level. The same strategy can make one trader profitable and another trader unprofitable, depending upon how it is traded. In fact, the same strategy in the hands of 100 different traders tends to produce 100 different results. Winning streaks and losing streaks are just simply a part of business, and understanding the true nature of random distribution will help you to religiously stick to your rules and follow your strategy when you experience short-term losing streaks. Now, the final mistake that so many amateur traders make is hopping between different strategies. So remember these two equity curves? They were generated by the exact same profit expectation. So essentially the exact same strategy, but random distribution led to a much rockier start for the trader on the bottom graph. So even though the strategy ends up well in profit after a large number of trades, when amateur traders experience the second scenario in their trading, their profit line forms an equity curve that presents a massive issue for them. Now this is a very exaggerated example due to the sheer number of trades, but the point is that most beginners who are just starting out, they have a tendency to trade a certain strategy only as long as it's in profit. They don't see it out long enough to see their edge play out, or they don't stick with it long enough to actually learn the strategy, test it, gather data, refine their plan, and actually master it. These things all take time and just cannot be rushed. Even when you are an experienced trader with a specific strategy, market conditions are not always going to be conducive for your system. There could be days or potentially even weeks, if you're more of a swing trader, when market conditions are just not conducive to the pairs or the instruments that you are trying to trade. So during this time, beginners traders, they often start trying to trade new pairs or a new instrument or even new strategies entirely. Now this isn't necessarily a bad idea, but 9 times out of 10, they haven't even come close to mastering their current strategy or the pairs that they're already trying to trade, and they are already moving on to something else just because the market may have shifted or they haven't mastered their current strategy yet. And this is just going to lead to an extremely scattered approach where you know many strategies and many pairs, but you don't know any of them in true depth. So you're a jack of all trades and master of none. Because there is a million ways to make money in the markets. And odds are that you won't be good at scalping, day trading, swing trading, and position trading. If you try to do them all, you're probably going to most likely end up a mediocre jack of all trades and master of none. So don't try to spread yourself too thin at the surface level. To truly reap the benefits of one strategy, you have to sacrifice the others. Identifying what you should focus on and specialize in is where that compounding momentum will take off. So, go deep on that and specialize, because that's where your processes and your results will become more predictable, scalable, and therefore sustainable. You will enjoy market cycles when your trading style outperforms other styles, and you'll experience cycles when your specific trading style will not perform as well. But generally, if you stick to your strategy consistently, then over time, the results will cancel each other out. And that's why the type of strategy isn't necessarily what's important, but it's the one that works for you that matters most. But you won't overcome less favorable phases by just adopting a different style each time you run into difficulty. To become great at anything, you must be focused and specialize, and you must avoid what's known as style drift. So to illustrate that point even clearer, this is a scenario of how most beginners approach the markets. They'll start trading a new strategy, and they'll only take a few trades before they become disheartened and then really frustrated that despite banking some really nice profitable trades, they're still floating around the break-even mark, or they're in a small drawdown. They then decide that the strategy clearly must not work, and they just go looking for another strategy that appears to be working well lately for other traders that they may know. The excitement of starting a new strategy that looks really good soon turns into frustration and dismay all over again as the strategy hits a period of drawdown, or more likely that they just don't have the required knowledge and experience to execute it correctly. And again, without giving time for the underlying edge to play out over a large enough sample size of trades, the trader is too annoyed and impatient, so he decides to give this whole trading thing just one last try and goes on a hunt to find another new shiny strategy that may look promising. This trader has now entered a very dangerous downward spiral of doom. He starts venting on social media, joining other trading forums to complain about a situation where he meets other beginners who are in the exact same situation. And their ignorance and inexperience just ends up fueling each other's beliefs that successful trading is just not possible. This graph is designed to explain just how important it is to trade your strategies consistently, persistently, but to also have patience. Now, this doesn't mean that you should just keep blindly executing every trade you think you see in the hope that suddenly your equity curve will start to rapidly rise in profit over time. You still need to be reviewing your trades and making sure that you are executing high probability setups that perfectly fit your trade plan. And you need to make sure that you are minimizing the amount of high probability missed trades as much as possible. So by doing those things, that is how you make sure that you have the highest chance of your edge playing out efficiently, and you will ride out any short-term drawdown periods that are natural and expected during those more unfavorable periods that you may experience in the market. Now, it can be difficult not to trade, especially when you have a lot of outside influence, Instagram, Twitter, YouTube, and you see people catching these amazing entries, maybe on pairs that you don't even trade or with a strategy that you don't even use, and appearing to make loads of profit. But it's been a quiet week for you, so now you're tempted to try and do what they're doing. And you think, if this person's making loads of money trading that pair or using that strategy today, then I'm going to start trading that different pair or trying that strategy that I've never even heard before. And you just end up trying to chase the markets and losing money. So when either market conditions aren't conducive, or maybe your mindset or your knowledge isn't currently at where it needs to be to perform, then what can you be doing in that time? Well, you need to make the best use of your time. And you want to trade? Well, why don't you just backtest then? In particularly, really busy days or weeks, I don't have that much time to backtest and improve my edge or potentially develop a new edge. So when you have those quiet periods, that's the perfect time when you can start to be gathering data. You can be building out a spreadsheet and you can be really, really refining your edge. Working out what market conditions does it work in. What conditions does it not work so well in? You can even be testing new instruments. Maybe you want to be getting into stocks, commodities, different FX pairs. That is your time to do that. Now, as you move over into the more professional side of things, that's what you need to be doing. You need to be very aware of the market conditions and whether they are conducive to your strategy or not. And you need to be able to pick that up very, very quickly. Because sometimes you can be insanely motivated. You wake up and you're in the perfect mindset for trading, but then at the same time, potentially the market conditions are not so great for your strategy. So what you need to do is harness and use that energy and that motivation to improve your strategy and your edge and really master your craft. So that wraps up this lesson. Now, the main thing that I want you to take away from this video is just really understanding the role that random distribution plays in trading. Because we have no idea in what sequence or order our wins and losses will occur in. So you need to be consistent with your actions. Don't vary your risk on each trade. Try to minimize missing as many high probability setups as possible. And that way the gap between your performance and the strategy performance will be much smaller. Your performance discrepancy will be minimized. And lastly, don't get shiny ball syndrome, hopping between strategies, styles, or instruments that you have no experience in. Make sure you truly master your strategy, because that is where the freedom lies.